All right, let's dive in. We're tackling cycle theory in financial markets today. Specifically, we're looking at J.M. Hurst's profit magic of stock transaction timing, trying to crack the code of those recurring patterns in market prices.
Yeah, exactly.
This is going to be like a crash course. We're aiming to distill the core principles, the tools you'd actually use, especially if you're gearing up for, say, an exam on this stuff.
Yeah, I think that's a really good approach, just get to the heart of it, the stuff that matters.
Mm.
Hurst had these 7 fundamental ideas, right? He called them the principles of commonality. It was cyclicality, harmonicity, summation, synchronicity, then proportionality, nominality, and variation.
Nothing awful.
Yeah, and these principles are going to be the foundation for pretty much everything we talk about today.
Got it. So starting with cyclicality, what's that all about?
Well, the basic idea is that every financial market, they all have cycles. But here's the catch. Not every market dances to the same cyclical tune. That's where a top-down approach really comes in handy.
Okay, so top-down meaning.
Starting broad, like with the S&P 500. Then you narrow it down, maybe look at sectors, then individual stocks. Hearst found that when you group securities by their dominant cycle period, it can really sharpen your entry and exit timing, see how different parts of the market are moving together.
So, like, the energy sector might be on a completely different cycle than, say, tech stocks.
Exactly. Knowing that helps you kind of anticipate when each area might make its next move.
So next up, we have harmonicity.
Harmonicity, that sounds like it has to do with cycles interacting, maybe.
You got it. Those dominant cycles, they don't just operate solo. They have these related cycles. We call them harmonics. They're like fractions or multiples of the main cycle's length.
Fractions, multiples.
Most common ones are the second harmonic, that's half the dominant cycle's length, and the third harmonic, which is a third. You'll also see a half and aura harmonics, but they're less common. It's double and triple the dominant cycle's length, respectively. Okay, so say we have a main cycle that lasts, for example, a year. Then we might see a 6-month cycle, the second harmonic, and maybe a 4-month cycle, the third harmonic.
Exactly. The interplay between all those harmonic cycles, that's what really drives price action.
Makes sense. And that leads us to the next principle, summation.
Right. Summation.
Which I'm guessing means all these cycles, they kind of add up or combine somehow.
Absolutely. Summation means every price move we see, it's the combined effect of all those individual cycles. The main one, all its harmonics, they're all layered together along with the overall trend. The assumption is that each cycle contributes equally.
So what we see on the chart is the sum total of all those forces acting together.
Exactly.
And from what I remember, this summation idea leads to patterns like, what was it, the mid-cycle dip and the three-quarter cycle high?
You got it. The mid-cycle dip, that's a tricky one. It's basically a little price dip that often happens right around the time of the dominant cycle's peak. It's the interaction of that dominant cycle and its second harmonic. Recognizing that pattern, that can really give you a clue about where you are in the dominant cycle.
So a dip right near the peak. That's counterintuitive.
Yeah, and because of that dip, the actual highest point often ends up being somewhere between the midpoint and the three-quarter mark of the cycle.
Ah, the three-quarter cycle high.
Right. Understanding that can help you anticipate the cycle's high point, potentially spot shorting opportunities if you're thinking in terms of cycles. Like maybe it's about to move down toward the next dominant cycle low.
So the mid-cycle dip helps us fine-tune our expectations for the high.
Precisely.
Now, there was something about the third harmonic influencing this, right?
Absolutely. That third harmonic can actually make the high of the dominant cycle even higher. Sometimes it can be so strong it wipes out the mid-cycle dip altogether. So paying attention to which harmonics are at play can really give you a detailed view of potential cycle tops.
So it's adding extra upward pressure when the dominant cycle might otherwise be peaking.
Yeah, that's a good way to think about it.
Okay, moving on. We have inversions next. I'm guessing that means things kind of flip around from what we'd expect.
That's the gist of it. A cycle inversion, you see a swing high where you normally expect a cycle low. It might be a sign that the cyclical structure is shifting a bit.
And there were a couple of main reasons why an inversion might happen.
Yeah, 2 main things. First, it could be a change in the strength of the harmonic cycles. Maybe the second harmonic's losing steam or a larger harmonic is taking over. The other possibility is the dominant cycle's third harmonic. Remember, that can mess with the typical cycle pattern. So if you see a potential inversion, go back and look at recent cycles. See if that third harmonic has been consistently playing a big role.
So inversions are like a heads up to re-examine the whole harmonic picture.
Exactly.
And then we have synchronicity. I'm thinking this is about cycles moving in sync.
That's a good way to put it. Synchronicity helps explain why market bottoms often feel so sharp, those aggressive V-bottom drops. While tops tend to be more drawn out, we call those rolling tops.
Why the difference in how those tops and bottoms form?
Picture this. Those smaller, even harmonics, they often bottom out right around the same time as the next bigger cycle, especially when they all converge at a dominant cycle low. All that downward pressure at once, that's what creates those rapid V-bottom reversals.
But the peaks are different.
Yeah, they're more staggered. You rarely see multiple cycles all peaking at the exact same moment. Instead, you get a rolling top, because different harmonics are cresting at slightly different times.
So a collective downswing for those sharp bottoms, but a more individualistic peaking for those drawn-out tops. Makes sense. Now on to proportionality. I'm picturing some kind of balanced relationship here.
Yeah, you're on the right track. Proportionality means there's a link between a cycle's period, that's its length in time, and its amplitude, the size of the price swing. Generally, longer cycles, the ones showing the broader trends, they set the stage for the shorter cycles.
So the multi-year cycle, that's the overall trend, and those shorter, like weekly or monthly cycles are the fluctuations within it.
Exactly. And, this principle really ties in well with those fractal patterns you often see in technical analysis, like Elliott wave theory, where you see similar patterns repeating across different time frames.
Right. The longer cycles dictate the trend for the shorter ones, and this pattern kind of repeats itself across different time scales. Okay, next we have nominality. Sounds like cycles have like typical or expected lengths.
That's the basic idea. Nominality suggests that certain cycle periods, they just show up more often in financial markets. Now you have two models presented, Hurst's nominal model and Garrett's nominal model.
And there were some differences between those two, right?
Yeah, Hurst's is based on calendar days and includes multiples of both 2 and 3 for harmonics. Garrett's uses trading days and focuses only on multiples of 3. Remember, these aren't hard and fast rules, more like observations of common patterns.
So not like predicting specific dates or anything.
Right. The key takeaway is to stay flexible, use tools like spectrograms, which we'll get to figure out what cycles are actually present in a market. These models are frameworks, but the market can, and often does, deviate from them.
Okay, good to know. So these are tendencies, but we always need to analyze what's actually happening. And lastly, we have variation, which sounds like the real world throwing a wrench into our neat theoretical cycles.
You nailed it. Variation acknowledges that cycles in real life, they aren't perfectly symmetrical or consistent. They can fade, new ones can pop up, and news or events can throw off their timing and size.
And that's where the whole translation thing comes in.
Exactly. Translation means a cycle low happens earlier or later than expected. Often it's because of the influence of bigger harmonic cycles. They might be bottoming out sooner or later than expected. For example, in a strong bull market, you're more likely to see cycle lows happening early, while in a bear market, they tend to be late.
Makes sense. So if we expect a cycle low on a certain date, but the market bottoms out earlier because it's in a strong uptrend, it's like the momentum is pulling the cycle forward.
That's a good way to visualize it.
Cycles aren't fixed, they're dynamic, they react to what's happening in the broader market. Okay, so we've covered those 7 principles of commonality from Hurst. Now, how about some tools we can actually use to analyze these cycles? What about this phasing thing?
All right, phasing.
Yeah.
That's all about aligning the actual price lows we see with the theoretical cycle lows. It involves calculations, but also visual interpretation. It's both art and science, really. We're going to look at centered moving average envelopes, or CMAs, and then valid trend lines, those are VTLs.
CMAs sounds like a variation of your typical moving average.
Yeah, but how we construct it is really important. It's a 2-step process. First, you calculate a moving average that's half the span of the cycle period you're interested in. So for a 100-day cycle, you do a 50-day moving average. Then you shift it back in time by a quarter of the cycle period. So for that 100-day cycle, you'd move the 50-day MA back 25 days.
Why do we shift it back?
Regular moving averages, they lag behind price, right? So by centering it, we try to line up the moving average with the theoretical cycle. Makes it a better filter for seeing those cyclical moves.
So if the CMA is sloping down, that suggests the cycle is in a decline, and if it's sloping up, we're in the rising phase.
Exactly. We're basically trying to remove some of that lag that you get with normal moving averages. Gives us a clearer picture of the cycle itself.
Okay, the CMA is the middle line. How do we build the upper and lower bands of the envelope?
3 steps. Take the centered moving average as your center line. Then You create the upper band by adding a fixed number of points to that center line. You adjust that number so the upper band captures most, but not necessarily all, of the price highs. And for the lower band, you subtract a fixed number of points, aiming to include most, but not all, of the lows.
Got it. And the number of points we add to the top and bottom, those can be different.
Yes. And those values, they're also going to be different for each market because of differences in volatility. The key is those envelopes help us see the historical crests and troughs of the cycle. Really useful for phasing. But remember, they don't project into the future.
Right. Now, there was this idea of nested envelopes as well.
Oh yeah, that's just plotting CMA envelopes of shorter period harmonic cycles inside the envelope of the main cycle. You'll often see significant turning points in price where those shorter envelopes hit the boundaries of the longer one.
So CMA envelopes help us visualize the cycles. What about those valid trend lines, the VTLs? How do they fit into all this?
VTLs, they're trend lines drawn with specific rules. First, they can't cut through the price action at all. Second, they have to connect two consecutive peaks or troughs of the same cycle period. And third, a downtrend line can't connect two highs if there's a larger cycle trough between them. That last one only applies to downtrend lines, by the way.
Okay, so specific rules. How do we interpret breaks of these VTLs when we're phasing?
So let's say you have a rising VTL connecting consecutive lows of a cycle. If the price breaks below that, even temporarily, it suggests that the highest high within that VTL period, it's probably tied to the peak of the next larger harmonic cycle. And the opposite is true for a falling VTL connecting consecutive highs. If price breaks above that, it suggests the lowest low within that VTL's time frame is associated with the trough of the next larger harmonic. So breaks of VTLs, they can give us clues about those larger cycles.
Okay, VTLs are like signposts, maybe hinting at shifts in the bigger cyclical forces. Now, the outline also mentioned oscillators. How do we use those in cycle analysis?
Oscillators, they're great for timing trades and refining your phasing analysis. You just have to tune them to the cycle you're looking at. And by tuning, I mean adjusting their period.
Is there a general rule for that?
Well, a lot of people set the oscillator period to about half the length of the dominant cycle. This often leads to overbought readings lining up with cycle highs and oversold with lows. But, many analysts prefer divergence. That's where the oscillator's movement doesn't match the price action. For spotting divergence at cycle lows, it's usually better to use an oscillator with a period about a quarter the length of the dominant cycle.
So different oscillator periods can give you different insights into potential turning points. All right, we've gone through the principles and the main analytical tools. What's the actual process for doing a cycle analysis?
5 basic steps. Start with visual analysis of the price chart. Look for those wave-like patterns. Then, use a spectrogram to help pinpoint the dominant cycles and their harmonics. Third, phase the dominant cycle, often using a CMA envelope. Then phase the shorter and longer harmonic cycles. Remember, they should ideally bottom out with the dominant cycle lows. Finally, you bring it all together for a complete phasing analysis.
Got it. Now let's see these tools in action with some real-world examples. First up, the OIH ETF, which tracks the oil services sector.
Okay, so remember, cycle analysis works best in markets that are either range-bound or consolidating. Not as clear when you have really strong, sustained trends. OIH has had both strong ups and downs, so it's a good example.
And we start with visual analysis. What do we look for on the OIH chart?
Try to spot those consistent pulses in the price action. Look for potential wave structures, especially the mid-cycle dips and those 3-cycle highs. The more recent and well-defined those patterns are, the more relevant they probably are to the current cycle. Pay close attention to the time between those lows. That can help you get a feel for potential cycle lengths.
Okay, so visual first. Then we bring in the spectrogram, right? What does that tell us?
The spectrogram helps us identify those dominant cycles more objectively. You'll see spikes on the chart. The height of a spike, that shows the strength of a cycle. The width shows its consistency. Start with the tallest spikes, the strongest cycles, and then check if their expected harmonics are also there and strong. In this case, we see a cycle around 637 days standing out for OIH. Then we adjusted that to 636 days for better harmonic alignment. And there's a clear second harmonic around 318 days, confirming that.
So the spectrogram pinpoints the dominant cycle and its harmonics. Now, we phase that dominant cycle using a CMA envelope, right?
Yep, for OIH's 636-day dominant cycle, we calculate a 318-day moving average, then center it by moving it back 159 days. That becomes the middle line of our CMA envelope, showing us the rhythm of that dominant cycle.
Okay, and then?
We align the peaks and troughs of that envelope with the actual price highs and lows. remembering that a bit of translation, either left or right, is normal.
And then we phase the harmonics, right?
Right. The lows of those shorter harmonic cycles, ideally they line up with the lows of the dominant cycle. In OIH, that 318-day second harmonic, it lines up pretty well with the intermediate swing lows within the dominant cycle. Now, phasing the bigger harmonics, that can be a little trickier. You have to find significant price lows that happen at roughly multiples of the dominant cycle's period. Look at those mid-cycle dips and three-quarter cycle highs to confirm.
And all this leads to that complete phasing chart.
Exactly. It puts all those phase cycles together. You can really see those cyclical relationships over time. It's fascinating to see the connection between those big declines in OIH around 2008 and then again in 2015.
Right. So that's OIH, where the cycles are pretty clear. But what about a market in a strong uptrend, like XLV, which tracks the healthcare sector?
Well, those strong trends can sometimes mask those cycles, makes analysis a bit harder. But the process is the same. Start with visual analysis, look for those wave patterns, even if they're not as obvious. When we look at the spectrogram for XLV, it shows a more complex picture. There are multiple dominant cycles, each with their harmonics. The analysis focuses on a 474-day cycle as the main one, along with its second and half harmonics. The example highlights an important point. Bull markets can sometimes suppress those shorter-term cycles, while sideways periods actually amplify them.
So even with a strong trend, those underlying cycles are still there. They're just not as easy to spot on the chart.
Exactly. The tools are still valid, but the interpretation needs a little more nuance. You have to consider that bigger trend.
Okay, so we covered a lot. Hurst's principles, those CMA envelopes and VTLs, using oscillators, the whole process and how these things work in different market situations. If someone's studying for an exam on this, what are the most important things to know?
I'd say first, know those 7 principles of commonality inside and out. Be able to explain each one and what it means for how markets behave. Understand the mid-cycle dip, three-quarter cycle high, what cycle inversions are and why they happen, how synchronicity plays into V-bottoms and rolling tops, and the relationship between a cycle's length and size, those common cycle lengths, and how real-world variations affect things.
And in terms of those analytical tools.
Know how to calculate and interpret a CMA envelope. Understand those rules for valid trend lines, and how to tune those oscillators to find turning points and divergence.
It's really cool how it all ties together. Like understanding harmonicity helps explain that mid-cycle dip, which helps us use the CMA envelopes, and synchronicity helps us understand those formations at market tops and bottoms.
Exactly. For an exam, being able to not only define the concepts, but also show how they connect to each other, that's key.
This has been a really in-depth look at cycle theory. We hope this overview helps our listeners get a solid grasp of the key ideas and tools.
Absolutely.
And this leads to a final thought for you, the listener. How might this understanding of cycles give you a new way to look at the current market trends? What about those potential turning points you're seeing? We encourage you to keep exploring the tools and principles we've discussed. See how they can improve your market analysis.
Couldn't have said it better myself.
That's all for today's deep dive.
Until next time.